I've seen folks wipe out their retirement funds for 70 years, and the strategies never seem to change. They believe that playing it safe means steering clear of risks. That's not the case. Real safety comes from knowing what you've got and the reasons behind owning it. A lot of retirees mix up feeling comfortable with being secure. They're after something that gives them a warm and fuzzy feeling, rather than something that's actually secure. There's a clear distinction. A certificate of deposit might feel safe because its number stays the same. However, if it's yielding 3% while inflation is at 5%, you're basically losing money at a snail's pace. That's not safety. That's just a pretty way to ruin your finances. Let me set the record straight. There's no such thing as an investment that's 100% safe. Anyone who claims otherwise is either clueless or trying to sell you something. What you can find are smart trade-offs. You can swap growth for steadiness. You can exchange liquidity for returns. You can choose simplicity over complexity, but you can't have the highest level of safety, the best returns, and top liquidity all at the same time. The universe just doesn't work that way. When folks come to me asking about secure investments for their retirement, they're often missing the point. They're looking for me to list specific products, but it's not the products that ensure your safety. It's your mindset that does. I could share the top 3 investments for retirees, yet you could still end up losing it all if you panic at the wrong time or go after high returns when it's not smart. So before I dive into what you should consider owning, let's get one thing straight. The biggest threat in retirement isn't the market itself, it's you. Your feelings, your impatience, your desire to outsmart everyone else. Those factors can do more damage to your portfolio than any economic downturn ever could. Now, if you can keep your cool, if you can stay put when everyone else is in a frenzy, if you can think rationally when fear is at its loudest, then these 3 investments will be beneficial for you. Not because they're some kind of magic solution, but because they're built for resilience. They won't make you wealthy in a flash, but they'll prevent you from ending up broke. And when it comes to retirement, that's the only game that truly matters. The very first investment that any sensible retiree ought to consider is something so mind-numbingly dull that most folks can't handle it. They crave excitement. They seek growth. They want to feel like they're making moves. What they truly need is the financial equivalent of a utility service. Consistent, reliable, and utterly unexciting. I'm referring to dividend-paying stocks from firms that have weathered every storm you've experienced and a few that you haven't. Not just any dividend stocks, but those that have upped their payouts every single year for decades. They're known as dividend aristocrats, and they symbolize something that many investors seem to have forgotten: discipline. These companies don't just dish out dividends when the going is good. They increase them even when times are tough. During the financial meltdown in 2008, while banks were crumbling and everyone was panicking about the collapse of capitalism, companies like Coca-Cola and Procter & Gamble continued to boost their dividends, not because they were feeling kind-hearted, but because they had the means to do so. They established businesses that brought in cash flow, whether times were good or bad. That's what retirees truly need, not some risky bets. They need a steady stream of cash that doesn't dry up when the news gets scary. A lot of folks think that safety is all about stable prices. They're looking for stocks that don't fluctuate much. That's a flawed way of thinking. Real safety comes from having a consistent income. I'm not worried if Coca-Cola's stock drops by 30% in a year. What matters to me is whether they keep sending out those dividend checks, and they will. People don't stop drinking Coke just because the economy takes a hit. They don't stop brushing their teeth or doing laundry. Human habits tend to stay pretty consistent, even when the markets are all over the place. That kind of stability is worth way more than any growth stocks that promise to double your investment. When you invest in dividend aristocrats, you're putting your money on something dependable. Human behavior. People will continue to buy the same essential products they've been using for 50 years. That won't shift just because a politician got into office or some central bank tweaked interest rates. The great thing about dividend stocks is that they tackle two issues at the same time. First off, they provide you with income without making you sell any shares. This is super important when you retire because selling shares during a market downturn locks in your losses. If you're relying on dividends, you never have to sell. You simply collect the checks and wait for things to stabilize. Secondly, they help you stay grounded mentally. When the market dips and everyone's freaking out, it's way easier to keep your cool if cash is still coming into your account. You're not just staring at a number on a screen. You're actually receiving money. That's what separates rational actions from emotional breakdowns. Now, some folks might argue that dividends aren't a sure thing. That's correct. Companies can reduce them. But the aristocrats, the ones that have increased their dividends for 25 or 30 years in a row, they don't cut them easily. Doing so would ruin their reputation. And when it comes to these companies, their reputation is way more important than what they pull in every 3 months. They've created whole identities based on being reliable. That's not just about marketing, it's a strategy for survival. Take a look at Johnson & Johnson. They've increased their dividends every single year since 1963. That's through tough times like Vietnam, stagflation, a bunch of recessions, the dot-com bust, the financial meltdown, and even a pandemic. If you had owned that stock during your retirement, you would have enjoyed rising income through every crisis over the past 60 years without losing a wink of sleep. Now, think about trying to chase after the hottest tech stock or cryptocurrency. You could strike it rich, but you could also lose it all. In retirement, taking that kind of risk isn't an option. You don't have the luxury of time to bounce back. That's why sticking with the boring stuff pays off. It's not because it's thrilling, but because it's sustainable. I've been saying for ages that the ideal investment portfolio is one that lets you rest easy at night. Dividend aristocrats accomplish that. They're not flawless. Their prices might dip during bear markets, but the income keeps rolling in. And what really covers your expenses is your income, not the ups and downs of stock prices. If I were to create a retirement fund from the ground up, I'd kick things off right here. I'd put between 40 and 50% into a well-rounded mix of dividend aristocrats. Not just a couple, but at least 10 or 15 from various sectors. You want to include consumer staples, healthcare, industrials, companies that provide essentials people actually need, rather than just things they desire when they're feeling good. This isn't about striking it rich. It's about keeping your wealth intact. The best way to maintain that wealth is by owning shares in businesses that keep generating cash flow no matter what's happening in the economy. That's the first foundation. Income that doesn't disappear when the markets take a hit. Here's something about dividend investing that often gets overlooked. It's not solely about the cash, it's also about the mindset. When you hit 70 and the markets are plummeting, and every pundit on TV is saying the sky is falling, you need something solid to cling to. Not just hope or forecasts, but something real. A payment that shows up every 3 months, no matter what the stock market did the day before. That's like having mental armor. I've seen retirees with flawless investment portfolios freak out and sell off everything because they couldn't handle the stress of seeing their wealth go up and down. They lacked an anchor. Nothing to remind them that their businesses were still running, still selling stuff, still making money. Dividends serve as that anchor. Each time you get one, it's a sign that your investment strategy is still on track. The company is still bringing in cash. Your retirement isn't reliant on some greater fool paying more for your shares. You're getting rewarded for being a part owner. That's genuine. That's something you can count on. And that's what allows you to rest easy at night while everyone else is up worrying. Now, let's tackle something that trips people up. They spot a stock with a return of 2 or 3% and think that's not enough to live on. They're correct, but they're missing the bigger picture. The yield is merely the starting point. What really counts is how that return develops over time. If you grab a stock that's giving you a 3% yield today, and that company bumps up its dividend by 7% each year, in 10 years, you'll be raking in a 6% yield on your initial investment. Fast forward 20 years, and that jumps to 12%. That's the magic of dividend growth. Your earnings go up while your original investment stays the same. Now, let's look at bonds. If you buy a bond with a 4% yield, you'll be stuck earning that 4% forever. There's no growth, no shield against inflation, just a gradual decline in real returns. On the other hand, dividend growth stocks provide you with both income and a hedge against inflation, because solid companies tend to increase their prices, and when they do that, they can also boost their dividends. You're not just battling inflation, you're actually gaining from it. That's why I've always leaned towards stocks over bonds for retirees. Sure, stocks can be more unpredictable, but remember, volatility and risk aren't the same thing. Volatility is all about price changes, while risk refers to a permanent loss of your capital. If you're not selling, that volatility won't hurt you. It's just background noise. Sure. Here's a reformulated version of the text. Inflation impacts you every day, whether you see it or not. One of the great things about dividend aristocrats is that they naturally choose quality, allowing them to increase your dividend year after year. For 30 years straight, you can't afford to be careless. You can't pile on too much debt. You can't make foolish purchases. You need to manage things carefully, because if you cut the dividend, you lose your reputation. Investors will run for the hills. Your stock will take a hit. So these companies tend to be quite conservative by nature. They've created a culture focused on managing capital wisely. That's precisely what you want when you're retired. Not companies taking wild risks, but those that play it safe. There's another advantage that's trickier to measure, but just as crucial. Dividend aristocrats usually have steady, unexciting businesses. They're not out there shaking things up. They're not on a mission to change the world. They're simply selling everyday items like soap, toothpaste, and soda. It might sound dull, but when you think about it, stable businesses tend to last. Thrilling businesses often don't. I've witnessed numerous groundbreaking companies fade away. However, I've never seen Colgate Palmolive vanish, since teeth are always going to be a priority. That level of reliability is definitely worth the investment. When you reach 75 and are relying on your savings, you don't want to fret about whether your assets will still be around in a decade. You want firms with such strong foundations that even poor management couldn't bring them down swiftly. Everyday necessities offer that stability. Healthcare offers that stability. Utilities provide that stability. These aren't engines for explosive growth. They're machines for survival. And survival is exactly what retirees need the most. Now, I can guess what some folks might be thinking. What about tech? What about innovation? Shouldn't retirees be investing in the future? Nope. Retirees should focus on the here and now. Let the younger generation take risks on what's to come. They've got time to bounce back if things don't pan out. You don't have that luxury? That doesn't mean you should steer clear of all tech, though. Microsoft and Apple are now dividend powerhouses. They've evolved from growth stocks into reliable cash flow generators, and that's perfectly okay. Sure. Here's a reformulated version of the text. Inflation impacts you every day, whether you see it or not. One of the great things about dividend aristocrats is that they naturally choose quality, allowing them to increase your dividend year after year. For 30 years straight, you can't afford to be careless. You can't pile on too much debt. You can't make foolish purchases. You need to manage things carefully because if you cut the dividend, you lose your reputation. Investors will run for the hills. Your stock will take a hit. So these companies tend to be quite conservative by nature. They've created a culture focused on managing capital wisely. That's precisely what you want when you're retired. Not companies taking wild risks, but those that play it safe. There's another advantage that's trickier to measure, but just as crucial. Dividend aristocrats usually have steady, unexciting businesses. They're not out there shaking things up. They're not on a mission to change the world. They're simply selling everyday items like soap, toothpaste, and soda. It might sound dull, but when you think about it, stable businesses tend to last. Thrilling businesses often don't. Your earnings have increased to around $40,000 or $50,000 each year from the same initial investment. Your tech shares, some bounced back, but most didn't. Even if you chose the winners, you spent 2 decades worrying about whether you made the right choices. Meanwhile, the dividend investor simply collected their checks and enjoyed a good night's sleep. That's the key difference between speculation and investment. Speculation hinges on being correct. Investment only needs you to avoid being disastrously wrong, and the best way to steer clear of disaster is to invest in businesses that have already shown they can weather any storm. So when I mention that dividend aristocrats are the first foundation of retirement security, I'm not just referring to income. I'm talking about mental peace, protection against inflation, safeguarding your capital, and the ability to tune out market chatter, all bundled into one unexciting package. Most folks won't go this route. They'll pursue higher returns from riskier options. They'll grab junk bonds or preferred stocks or master limited partnerships. They'll find out the tough way that getting returns without safety is merely a loan you're giving to someone who likely won't be able to pay you back. Don't fall into that trap. Embrace lower returns from higher quality investments, because in 30 years, the solid, low-return stocks will have outshined the high-return junk by a factor of 5 or 10. Not by some kind of magic, but through survival and compounding. That's the first type of investment. Dividend aristocrats. Not all your cash, but the core, the foundation, the part that allows you to rest easy while everything else is in chaos. The second investment that retirees should consider is even more straightforward than the first, which is why nearly no one gets it right. Folks tend to dislike simplicity in finance. They believe that if it's not complicated, it can't be beneficial. That's a misconception. The best concepts are often simple. They're just tough to put into action because they demand patience rather than cleverness. I'm referring to index funds, specifically broad market index funds that encompass everything. The S&P 500, or even better, a total market index. One fund, countless companies, no need to guess. Most folks retiring shouldn't be picking individual stocks. That's not a dig, it's just math. If you're not sure what you're doing, picking stocks is like playing the lottery. And even if you do know your stuff, you're up against pros with better intel and quicker computers. The odds aren't in your favor. But here's the deal. You can own all of them. When you invest in an index fund, you're not wagering on the brilliance of a single company or the momentum of one sector. You're placing a bet that people will keep getting up and trying to earn money. That's a gamble I'm willing to take every single time. It's been effective for ages, and it'll keep working for the next 100 years too. The magic of index funds lies in their ability to take emotion out of the mix. You can't fiddle around. You can't outsmart yourself. You simply own the market and let it do its thing, which is to rise over time while giving everyone a bit of a scare along the way. From 1928 to now, the S&P 500 has given back roughly 10% every year, though not consistently. There are years when it drops 30 or even 40%, but over the long haul, it builds up without stopping. And that building up is the closest thing to magic in the world of finance. While it's happening, it doesn't feel magical at all. It often feels tedious, but that tedium is what really works. Zig Ziglar and I have been saying this for ages. The typical investor would be way better off just buying a low-cost index fund and doing absolutely nothing. No trading, no trying to time the market, no paying attention to predictions. Just buy it and forget about it. The issue is that people can't handle doing nothing. They feel the need to be productive, so they end up trading, switching funds, chasing after performance, and every time they do, they hurt their returns. The numbers are harsh. The average investor lags behind the market by multiple percentage points each year, not because they choose bad stocks, but because they can't stay put. They buy when they're excited, leading them to purchase high, and sell when they're fearful, resulting in selling low. Index funds fix this by making activity unnecessary. There's really nothing to stress about. The fund adjusts itself automatically. You just chill and let capitalism do its thing. Nowadays, folks are anxious about market downturns. They ask, what if I put my money in and the market drops by 30% next year? My response is pretty straightforward. If it drops by 30%, then it drops. So what if you're retired and relying on dividend stocks for your income? Your index funds are meant for growth in 20 or 30 years down the line. You're not touching that cash this year or the next. You'll be using it when you're 85. By that time, every market crash will feel like a distant memory. The trick is to set up your portfolio in a way that you're never compelled to sell during tough times. That's where the dividend stocks and cash reserves come into play. The index funds just hang out, quietly compounding while everyone else freaks out. I've seen this pattern unfold for 70 years. Markets take a nosedive, people panic and sell, markets bounce back. Those who sold end up regretting it. Then markets surge again and people jump back in with excitement, only for the markets to crash once more. It's the same cycle over and over again. The only investors who really come out on top are those who completely disregard the cycle. Index funds simplify that because you don't have to stress over specific company news. It doesn't matter if one tech firm misses its earnings or if a bank gets a downgrade. You've got a piece of all of them. If one stumbles, another one thrives. That's what diversification is all about. It actually holds value. If I were managing a retiree's portfolio, I'd suggest putting 30 to 40% into a total market index fund. Keeping costs low is essential. You want those expense ratios to be below 0.1%. Every extra percent you shell out in fees is a percent you miss out on compounding. Over 30 years, those fees can eat away at a third of your wealth. That's not just a small mistake, that's outright robbery. The great thing about index funds is that they grow alongside the economy. When the economy expands, your fund expands. When productivity goes up, your fund benefits from it. You're not placing your bets on the genius of one CEO or the future of a single industry. You're banking on the collective effort of humanity. Humans have a knack for building value over time, even if they tend to freak out now and then. So the second key point is pretty straightforward. Take ownership of everything through index funds. Not because it's thrilling, but because it works. Not because it's clever, but because it lasts. You don't have to be a genius to invest in an index fund. All you need to do is stay in the game. And that's where a lot of folks stumble. Let me explain why index funds are particularly important for retirees. It's not just about the profits. It's about cutting down on choices. Every choice you make opens the door to making a mistake. Every trade is a moment to panic. Every time you rebalance, there's a chance to mess things up. Index funds take away most of those risks. You buy once and hold on forever. Simple as that. That straightforwardness is crucial because retirement is when your ability to make decisions starts to wane. I don't care how sharp you were at 50, by 80 things slow down. That's not a dig, it's just how biology works. Your reaction time decreases and your capacity to handle complex information diminishes. You become more vulnerable to scams and poor advice. So when you hit 80, the last thing you want is a portfolio that demands constant care and complicated choices. You're looking for something you can set aside, something that performs well whether you're focused on it or not. Index funds fit that bill perfectly. They're the ultimate set it and forget it investment, and that's precisely what you need when your mental sharpness isn't what it used to be. There's another advantage that often gets missed. Index funds help you avoid making decisions based on your emotions and the latest news. When you own individual stocks, every earnings report feels like it's about you. Every downgrade from an analyst feels like a personal hit. You start to doubt yourself. Should I sell? Should I buy more? Is this company still a good choice? With an index fund, none of that is a concern. You don't have enough stake in any one company to worry about its quarterly performance. You just own the whole collection, and that collection tends to rise over time because that's how capitalism operates. Unas empresas malas se desvanecen, mientras que las buenas prosperan. El índice se ajusta de manera automática. No tienes que hacer nada. Esa función de piloto automático es increíblemente valiosa para los jubilados, ya que los peores errores de inversión suelen ocurrir cuando estás estresado, cansado o asustado. Y la jubilación trae consigo las tres cosas: problemas de salud, la pérdida de una pareja, declive cognitivo, caídas del mercado, caos político. Siempre hay algo que intenta hacerte entrar en pánico. Los fondos indexados te ayudan a resistir ese pánico al eliminar la necesidad de actuar. No puedes vender por pánico un fondo indexado y sentirte inteligente al respecto, porque estarías vendiendo todo, la economía productiva en su totalidad. Eso es claramente tonto, así que no lo haces, pero podrías caer en la trampa de vender acciones individuales por pánico, porque puedes contarte una historia sobre por qué esa empresa en particular está condenada. Los fondos indexados evitan ese autoengaño. También he notado que los inversores en fondos indexados duermen mejor, no porque sus rendimientos sean necesariamente mejores, aunque a menudo lo son, sino porque no están constantemente cuestionándose a sí mismos. They're not lying awake at night thinking about whether they should have sold Microsoft or bought more Apple. They're simply invested in the market, and the market will do its thing. That kind of peace of mind is invaluable. I'd pay a lot for a good night's sleep. A lot of folks spend a ton and still can't sleep well because they're complicating investing more than it needs to be. Now, some people have issues with index funds on moral grounds. They argue that you're putting your money into companies you don't support, companies that pollute, manufacture weapons, or engage in activities you don't agree with. That's a valid point. When you invest in an index, you're owning everything, the good, the bad, and the ugly. My take is straightforward. Your goal in retirement isn't to change the world. It's to ensure you don't run out of cash. If you want to make a difference, do it with your time and energy, not your retirement funds. Because the second you start filtering companies based on ethics or values, you introduce bias. And bias costs you money. Research after research indicates that value-based investing tends to underperform. Not because being good is a bad thing, but because you're limiting your options. You're cutting out companies that could potentially offer amazing returns just because they don't fit some random criteria. When you're retired, you can't really afford that kind of luxury. You need every edge you can find. And the biggest edge is having a wide range of investments. Owning a bit of everything means you won't miss out on the big winners. If you decide to exclude oil companies and the next 10 years are all about energy, you're doing yourself a disservice. If you ignore tech and tech takes over, you're hurting your own chances. The market doesn't care about your beliefs. It rewards what actually works. Your role is to seize those rewards, not to judge them. That might come off as harsh, but I've seen too many well-intentioned retirees end up struggling financially because they tried to invest based on ideals instead of numbers. Their ideals didn't cover their medical expenses. The market did. So absolutely, invest in the entire market, the ethical and the unethical, the loved and the despised, all of it. Your financial security during retirement is way more crucial than making a statement with your investments. Save your activism for your community service and your voting choices. Keep your investment strategy straightforward and practical. There's another reason why index funds are particularly important for retirees. They're super tax efficient. When you own individual stocks and need cash, you have to sell specific shares, which can lead to taxable situations. You've got to keep an eye on your cost basis, and you might end up triggering short-term or long-term capital gains. It can get pretty complicated, but with index funds, especially in retirement accounts, it's a breeze. The fund hardly ever distributes capital gains because it seldom sells off its holdings. It just keeps everything in place, so your money grows without being taxed or tax-free, depending on the type of account. That's a big deal over 30 years. I've seen folks lose 20 or 30% of their potential earnings to taxes just because they were always buying and selling. Index funds take care of that by promoting a hands-off approach, and doing nothing can be both financially smart and good for your mental well-being. Here's the deal with index funds. They're not thrilling. They won't make you feel like a genius. You can't show off about them at gatherings, but they'll steadily help you accumulate more wealth than 95% of those who are trying to outsmart the market. Because investing isn't about being the smartest. It's about making the right choices. And the simplest way to get it right is to own a piece of everything and just wait. That's exactly what index funds allow you to do. So the second key to a secure retirement is a broad market index fund. Aim for 30 to 40% of your investment portfolio. They're low cost, unexciting, and effective. You buy in, forget about it, and let it grow over the next 20 or 30 years. And when you hit 90 and need some cash, it'll be waiting for you. It'll have quietly increased while you were busy enjoying life. That's the idea. Investing should be a background activity, while you concentrate on what truly matters: family, health, experiences, not stock prices and earnings reports. Index funds make that a reality. They're like having your investments on cruise control. You set your goal and just kick back. The system will take you there. That's the second kind of investment. Straightforward, reliable, and relentless. The third type that retirees should consider is one that most folks shy away from because it doesn't seem like an investment at all. It doesn't give you any dividends. It doesn't create any growth. It simply sits there, doing nothing while inflation quietly eats away at its worth. I'm talking about cash. Not the cash stuffed under your bed. Not the cash in a checking account that earns you nothing. Cash equivalents, short-term treasury bonds, money market funds that are backed by government obligations. These are the kinds of assets you can convert into cash for spending in 24 hours without breaking a sweat. People really dislike holding on to cash in retirement. They see it as being unproductive. They think about missed opportunities as if it's some sort of moral failing. They watch stocks rising and feel foolish for not having their money all in. That's completely the wrong way to think about it. Cash isn't just a burden, it's a smart strategy. It's your safeguard against being pushed into making a foolish decision at the most inconvenient time. Let me break down what happens to retirees who lack cash reserves. When the markets take a nosedive, they find themselves in need of funds to get by. They end up having to sell their stocks. And guess what? Those stocks are down by 40%. They sell anyway because they have no other option. Now they've locked in those losses for good. Then when the markets bounce back, they've missed out on that recovery. They're left worse off for life. All of this just because they didn't keep some boring cash on hand when they had the chance. I've witnessed this unfortunate scenario unfold countless times. Smart folks, solid portfolios, one misstep. They set up their finances as if the markets would never dip or as if they wouldn't need cash during tough times. Both of those ideas are just plain crazy. Markets will always drop eventually. You'll always need cash. Having cash on hand takes away that pressure. When you've got 2 or 3 years' worth of living expenses tucked away in treasury bills, you really don't care what the stock market does tomorrow. You're not in a rush to sell. You're simply using the cash you've already saved up. That kind of freedom is more valuable than any profit. Back during the 2008 financial meltdown, the folks who made it through weren't necessarily the ones who had the biggest gains in 2007. They were the ones who had enough cash on hand to avoid selling when prices were at their lowest. They could just hang tight while everyone else was scrambling. That level of patience really saved them. In some instances, it even made them rich because they could scoop up bargains when others couldn't. That's the power of having cash. It gives you options. When the market is booming, you use your cash. When the market dips, you let your stocks bounce back and use your cash instead. You're always making moves from a position of strength, never out of panic. The right amount of cash really depends on how much you spend. If you're spending around $50,000 a year, you should keep about $100,000 to $150,000 in cash or cash equivalents. That's about 2 to 3 years' worth of expenses. It might sound like a lot, and it is. But that's the whole idea. You want to have enough of a cushion so that even if stocks drop by 50% and stay down for 2 years, you're still okay. You're not feeling the pressure. You're not making choices out of fear. Folks might say that keeping 3 years' worth of expenses in cash means you're missing out on gains from the stock market. That's true, but it also means you're dodging those forced sell-offs during market crashes. I'd take that deal any day because when it comes to retirement, the aim isn't to get the highest returns. It's about ensuring you can survive. Here's another perk that hardly anyone mentions. Having cash on hand actually makes you a smarter investor. When you know your bills are sorted for years, your mind is clearer. You stop reacting to every headline. You quit checking your portfolio daily like it's a sports game. You can genuinely wait for things to stabilize. Without cash, you're at risk. Every little market dip feels like a crisis. Every news cycle seems like a call to jump into action. You end up making emotional choices that you think are strategic. That's how people end up in trouble. They mix up being busy with being smart. Now, some folks argue that keeping cash is risky because of inflation. They have a point in some ways. Cash does lose its buying power. However, losing 2% each year due to inflation pales in comparison to losing 40% in just 1 month because you panicked and sold your stocks. Risk isn't just a simple concept. The danger of not having enough cash on hand is much more significant than the risk of having too much. Short-term treasury bills are about as close to being risk-free as you can get. They're supported by a government that can print the money it owes you. They're easy to access, they're not exciting, and they provide exactly what retirees need the most: peace of mind. If I were putting together a retirement portfolio, I would set aside 20 to 30% for cash equivalents, not permanently, just as a safety net. As you use it up, you can replenish it by selling stocks when the market is doing well. It's a rotating reserve, not a long-term storage solution. The main takeaway is this: Liquidity serves as an emotional tool just as much as it does a financial one. It helps you stay level-headed when being rational is crucial. It stops you from making irreversible decisions at the worst possible moment. That's far more valuable than trying to chase an extra percentage point of return. All right, so the third pillar is pretty straightforward. Keep some cash on hand, not because it's thrilling, but because it provides stability, not because it generates returns, but because it helps avoid disasters. Folks who are retired don't need flashy investment strategies. What they really need are portfolios that can withstand bad luck or poor timing, and that's where cash comes into play. Let me explain what cash truly signifies. It's not just about the dollars and cents. It's about time. Cash gives you the luxury to think things over, to wait it out, and to let the markets bounce back without feeling pressured to jump into their craziness. That time holds more value than any investment gains. The biggest blunders in investing usually come down to timing issues. It's about buying too late, selling too soon, acting when you ought to hold back, and holding back when it's time to act. Cash helps you dodge most of those timing pitfalls by taking away the urgency. You never feel compelled to make a move. You can always afford to hold off for another day, another month, or even another year. It's that kind of patience that distinguishes successful retirees from those who struggle financially. I've witnessed folks with millions freak out because they didn't have enough cash to feel secure. On the flip side, I've seen people with just a little savings snooze soundly because they had 3 years' worth of expenses tucked away. The key difference wasn't about being wealthy, it was all about having a solid plan. Cash also acts as a safety net for you during those euphoric moments, not just when you're in a panic. When the markets are soaring and everyone seems to be cashing in, you'll feel the urge to dip into your cash reserves. Resist that urge. That's when you need it the most. Because when everyone's riding high, market crashes are just around the corner. And when those crashes hit, you'll want that cash to scoop up assets at a bargain, not to sell when things are looking good. That's the real discipline. Holding on to cash during the good times is trickier than during the downturns because during the highs, you might feel like a fool. Your buddies are raking in profits while you're just sitting on treasury bills earning 3%. They tease you, calling you scared. But 6 months into a bear market, those same friends are panicking and you're calmly using your cash while your stocks bounce back. Who's scared then? Having cash on hand allows you to support your family during tough times without putting your own finances at risk. If your child finds themselves out of work or your grandkid requires medical attention, you can step in to help without having to sell stocks at unfavorable prices. That kind of flexibility is invaluable because life doesn't care about how much you have in your investment account. Emergencies can strike no matter what the market is doing. If all your funds are tied up in stocks, you're just one crisis away from making a lasting mistake. Now let's tackle the inflation issue head-on, since it's the biggest concern folks have. Sure, cash does lose its buying power. With an inflation rate of 2%, $100,000 turns into $98,000 in real value after a year. That stings. But here's the thing that people overlook. That decline is something you can see coming. It's slow and it's manageable. Now think about what happens if you're all in on investments and the market takes a nosedive of 40% right when you need cash. You could lose $40,000 in just 1 month. That's like 2 decades of inflation loss in 30 days. One is a long-term issue, while the other is a sudden crisis. I'd choose the long-term issue over the sudden crisis every single time. Additionally, cash doesn't lose its worth in every situation. When there's deflation or disinflation, cash actually increases its purchasing power. In times of market downturns, cash becomes super valuable since it allows you to buy assets at lower prices. People often overlook the flexibility that cash provides until they find themselves in a pinch. There's also a mental aspect to consider. Just knowing you have cash on hand gives you the freedom to make better choices in other areas of your life. You're not in a state of financial panic. You can turn down poor opportunities. You can step away from deals that don't add up. You can take your time with your investments because you're not relying on them to cover next month's expenses. That mental clarity builds up to better results throughout your entire financial journey. The amount of cash you keep should also reflect your personality. If you tend to be more anxious, it's wise to hold on to more. 3 years might not cut it for you. Perhaps you need 5 years' worth of expenses in cash to feel at ease, and that's perfectly okay. The numbers show that you're missing out on potential gains, but the mindset suggests you'll make smarter choices when you're more relaxed. I'd prefer a less than perfect investment strategy that you can stick with rather than a perfect one that you'll ditch when things get tough. So be real about how much risk you can handle. Not what you hope it is, but what it truly is. If just thinking about stocks makes you feel uneasy, you probably have too many. Add some cash until you can rest easy. That's your best setup, not some equation from a textbook. And speaking of cash, it stands the test of time. Stocks need constant attention, companies can decline, and industries evolve. But Treasury bills from 2000 are pretty much the same as those from 2024. You don't have to stress over disruptions, competition, or changes in management. Just hold on to them until they mature and then reinvest. That straightforwardness is priceless when you're in your 70s or 80s and don't want to stress over finances. Lastly, having cash reserves helps you avoid the risk of fluctuating returns. That's a fancy way of saying a simple issue. When you retire and the markets take a nosedive, you might have to sell your stocks at a loss to cover your living costs. As a result, your investments might not bounce back since you've sold off the shares that could have recovered. Having cash on hand changes this game. You can use your cash during the downturn. Your stocks can then regain their value. Once they're up again, you can sell some off and replenish your cash stash. This straightforward approach can be the difference between a portfolio that lasts for 30 years and one that runs dry in just 15. So when I emphasize that cash is the third pillar of retirement security, I truly mean it. Without it, the other two pillars can falter in tough times. But with cash, you can ride out any storm. You're never in a position where you have to act out of desperation or fear. You're always calling the shots. That sense of control is what real safety is all about. It's not about chasing high returns, it's about having control. And cash is your ticket to maintaining that control when you can't simply earn your way out of errors anymore. Now let's dive into how all three elements are connected. Because having the right investments is just part of the equation. The other part is not messing them up with poor choices. And poor choices in retirement often show up in one of 5 ways. First up, impatience. You'll see stocks rising and feel like you're missing out. Holding onto cash might start to feel boring. You might think your dividend stocks are moving too slowly. That impatience can lure you into chasing something that seems quicker. Don't fall for it. The quickest way to lose money is by trying to make it too fast. Next, envy. Your neighbor might boast about their crypto profits or how their tech stocks have doubled. You'll start to feel foolish for sticking with those steady companies. That's when your self-control gets put to the test. Keep in mind, you can't see their losses. You only notice their successes. And those successes during market bubbles often appear much larger than they really are. Third, fear. Markets will take a dive. They always do. You'll come across headlines about economic disasters. You might feel the urge to sell everything and retreat. That's precisely when you should just sit tight. Fear often drives people to sell their assets at the worst possible prices. Don't be one of those folks. First up, let's talk about complexity. You'll come across fancy strategies, hedging, derivatives, and alternative investments. They might sound impressive, but don't be fooled. Complexity just hides risk, it doesn't make it go away. Stick to what you really get. If you can't break it down simply, then you probably don't know it well enough to invest in it. Next, let's discuss arrogance. You might have a great year and think you've got investing all figured out. That's when you might start taking bigger risks because you feel untouchable. But that's when you're at your most exposed. The market punishes arrogance way quicker than it does ignorance. Keep your feet on the ground. The aim isn't to feel clever, it's to keep your finances intact. If you steer clear of those 5 blunders, you'll likely do better than most investors without needing to pull off any crazy moves. You'll simply be the one who didn't mess things up. And when it comes to retirement, not messing up is pretty much the same as winning. Here's a plan I'd suggest. Put 40 to 50% into dividend aristocrats for some steady income and stability, and then 30 to 40% into broad market index funds for long-term growth. 20 to 30% in cash equivalents for liquidity and peace of mind. That's all there is to it. 3 categories: straightforward, reliable, and a bit dull. You adjust your allocations once a year. You draw from cash first. When your cash is running low, you sell from whichever category has appreciated the most. You never sell during market downturns. You don't chase after higher returns. You don't attempt to predict the market. You simply sit back like a sensible adult and let compounding work its magic. This won't make you wealthy overnight, but it will help you maintain your wealth for many years. And preserving wealth is trickier than accumulating it. Most folks don't realize that until it's too late. One more thing, the most crucial investment isn't even in your portfolio, it's in your mindset. If you stop learning, stop reading, and stop thinking, no amount of asset allocation will rescue you. Your judgment is your most valuable asset. Keep it sharp. Read annual reports. Dive into history. Know what you own and why you own it. The moment you stop learning is the moment you start making costly errors. I kept diving into books well into my 90s, not because I was after more cash, but because I wanted to keep my mind sharp. A keen intellect builds up just like money, maybe even more so. When you retire, it's not just about handling your finances. It's about managing yourself. Your feelings, your self-control, your capacity to think straight when everyone else is losing their cool. That's the true talent. It's not about picking the right stocks, but about keeping your sanity. If you can manage that, if you can set up your finances for the long haul instead of just chasing thrills, you'll be all right. Not because you were a genius, but because you were steady. And being steady over many years outshines brilliance every single time. Zig Ziglar and I didn't become wealthy by being smarter than the rest. We became wealthy by being less foolish for a longer stretch. That's the only advantage you really need. The 3 investments I mentioned are just tools. They'll work if you apply them right. They'll flop if you panic, chase after trends, give in, or mistake activity for progress. So the real question isn't about what to invest in. It's all about whether you can hang in there long enough to see it pay off. A lot of folks struggle with that. That's why so many end up not succeeding. Don't be like the majority. Embrace the mundane. Practice patience. Think logically. In time, the world will recognize your efforts. And when that happens, you'll come to understand something that many investors overlook. Safety wasn't just a purchase. It was a transformation you went through.